Okay, I think we'll just give a few of the late starters just a few more seconds to join in. Just a few more people have joined just now, so we'll just give that another minute. Okay, I think we'll make a start now. Thank you, everyone. Hello, and welcome to today's webinar, where we're delighted to be once again working with the CME Group. This is the second in a series of 3 webinars on options trading, brought to you by APM Capital and the CME Group. My name is Mark. I'm the head of risk at APM Capital. We are a leading financial broker located and regulated in Abu Dhabi by the FSRA. At APM Capital, we specialise in providing trade execution services, including offering the vast selection of futures and options available at the CME to our valued clients, whether they're retail, professional or institutional, both in exchange traded and also OTC markets. As a regulated financial institution, we're committed to providing our clients with the highest levels of service, transparency and security, and we take pride in building long-term relationships based on trust and integrity. We understand that the financial markets can be complex and ever-changing, which is why APM Capital is dedicated to providing the most up-to-date market insights and analysis, this series of webinars being among them, to help our clients make informed decisions and achieve their financial goals. So thank you for joining us today. We look forward to the opportunity to serving you as your trusted financial partner. So it's my pleasure to welcome back David Gibbs, who is Director of Education at the CME Group and a futures market professional with over 40 years of industry experience. Beginning in the open outcry pits of the Chicago futures exchanges, he has held leadership positions with global futures commission merchants and actively traded financial futures, options and cash market products for both buy-side and sell-side firms. He is an expert in pricing mechanism for derivatives, including financial futures and their underlying products. Leveraging that expertise, David is also a noted teacher of the application of futures and options and how they are successfully used by professional traders and managers of risk in today's increasingly unpredictable economic and geopolitical environment. Just before I hand over to Dave for the presentation, just like to say, if you do have any questions, please put them into the group chat and we'll get to as many of them as we can at the end of David's presentation. So thanks very much, Dave. Over to you.
Thank you, Mark. I trust you can still see the screen and I'm coming through loud and clear.
Absolutely, yes.
Brilliant. Well, thank you for that wonderful introduction. We're delighted to be partnering with APM. As mentioned, this is the second of 3 webinars on options. The first one, we began at the beginning. We started with the basics. We were talking about the fundamentals or foundational aspects of option terminology, defining those terms, defining and discussing the asymmetrical risk-reward relationship that exists with being long options. We looked at a little bit of the market structure and those sorts of things. Today, we're going to build on that knowledge, going a little more deeply into the pricing mechanics of options. What are the inputs that go into the premium calculations? And that will hopefully give us the foundation that we want for our third session, which will be in 2 weeks, or I guess a week from now, in person in Dubai, where we're going to leap off and look at various strategies for trading and risk management using options. So I'm going to begin as soon as I can figure out how to advance my, there we go, slide by, like we always have to do, is mention that our session today is meant to be educational and informative and is in no way to be construed as offering investment advice nor making trading recommendations. You may see examples of trades in the presentation, but that should not be construed as offering advice nor making recommendations to use futures and options. All right, it might be a good idea to just back up a little bit and remind ourselves, what is an option? Well, at CME, options are always going to be options on futures contracts, and that means the option buyer gives the right but not the obligation to take a long or a short position in the underlying futures contract, depending on whether they're in the put or the call. Those options have specific strike prices, and then they also have very specific expiration dates. The buyer, to get that right, pays what's known as the premium to the seller. The seller receives the premium and is then obligated to fulfill the terms of that contract should the option buyer exercise their rights. So what are the market forces that go into, or the conditions that affect the premium of an option? We're going to consider four. There are a few more, but these are the main ones, so we're going to focus on those today. Certainly the price of the underlying, which in the case of CME options will always be a futures contract. The strike price of the option, which is fixed, where the underlying price, the price of the underlying will be dynamic and be moving. The strike price of the option, whether it's a put or a call, is a fixed number. Then there's market volatility. And then lastly, the time until expiration between today's trade date and the expiration of the option. So these are the four conditions that we're going to be looking at. And the identifiers for these inputs are referred to by Greek letters. So we sometimes refer to these conditions as the Greeks, starting with the delta, which reflects the effect of change from the underlying futures product on the options premium. This is measured by what's known as the delta. It's the ratio that compares the change in the price of the underlying to the change in the premium of the option. It's expressed usually between a number of 0 and 100. It can be positive or negative, depending on whether you're talking about a put or a call. The delta on a call is generally reflected as a positive number, where the delta on a put, because it represents a negative market directional position, is expressed in negative terms. The deltas basically represent the probability of the market ending at the strike price at expiration. So, for example, a call option that's got a delta of 25 would be expected to go up in value by, if its underlying product were to go up by 1 increment, the premium of the option should go up by a quarter of a minimum tick increment. Likewise, if it's got a higher delta, in the case of this example, on a put, a negative 75 delta, we would expect that premium to increase by 3/4 of a point for every 1 full point downtick of the underlying. Sometimes I mentioned that these represent probabilities. So, for example, if you're an at-the-money put or call with a delta of roughly 50, that is suggesting that the market is pricing that premium to have a 50-50 probability of being at the money at expiration. The further for the call, the higher the underlying goes, the delta is going to increase because its probability of being in the money or at the money is increasing as the market trades higher. Conversely, if the market were to trade sharply lower, the deltas on the puts will increase because they have an increasing probability of being in or at the money at expiration in a price declining market. So a couple of different ways to be thinking about what we call the delta. These are examples from prices off a price sheet from CME Group's Quick Strike software, which you can see on our website and explore at your own. We're going to talk a little bit more about tools and resources at the end of today's presentation. But what you're looking at is basically a table with prices on E-mini options of the S&P 500 for the June contract. You'll notice that the June futures contract price here is 4180.25. 59 days until expiration. And by the way, because these are it's a cash settled futures contract, the June options for this product have the same expiration dates. This is common with a cash settled contract because there's no risk of physical delivery in advance of expiration. So The options for June on the E-mini S&Ps and on all the June equity index contracts are going to have the same expiration date as the underlying futures contract. So in this example, we're looking at strikes. The at-the-money strikes are the 4180s for both the puts and the calls. You'll notice that's in bold at the center of the table. If you move to the left column off the center column, you'll notice this is the premium of the call, 98 for the at-the-money 4180 calls, and it's got the delta of 51, roughly 50-50 chance of it being there. You'll notice as you go higher in strike, the deltas on the calls get smaller because they're out of the money, and the probability is less likely at this point that they're going to be in the money. Conversely, if you go down in strikes, moving up in the table, you'll notice the deltas increase because of the increased probability of being at or in the money at expiration. You'll also notice that at those lower strikes, the premiums are greater because the option has more intrinsic value. And the out-of-the-money options that are at the higher strike have lower premiums for exactly the same reason. They actually have no intrinsic value. It's all, in this case, represented by time value. These were some of the concepts we covered in our first session together. Now, if you move to the right side of the table, you're looking at the same type of mathematical calculations, but with respect to the puts. And you'll see that the put delta is negative 48, very close to 50, but not exactly. And as you move up in strike prices, the deltas are increasing because those put options are now in the money. They have a higher probability of being in the money at a lower price, as exampled here, and the premiums are higher. As you go down in strike prices, the opposite occurs. The deltas get smaller and the premiums shrink because they have no intrinsic value at this point. So we're going to be considering the impact of a change in the underlying price, in this case, the E-mini futures, relative to the strike price as it's expressed through the premium and the changes in that premium due to the changes in the underlying price. So if we consider the delta of the call, the 4180 call with the market basically at that price, it's priced at 98 index points. It has a delta of 51. The futures are right there at 4180 and a quarter. If the price were to move up by 1 index point to 4181 and a quarter, what do we think will happen to the price or the premium of the call option? Well, because the delta is at 51, that's mathematically 0.51, which means that if the premium were to go up by 1 full index point, the premium of the option should go up by a half an index point. Or if you want to think about it even further, if the market were to go up by 2 index points, the premium should go up by 1. So that is what the delta is measuring. If the market were to go up by 1 index point, that premium on the call should go from 98 to 98.5. If the underlying futures contract were to drop by 1 index point, it should fall by a half a premium point to 97.5, and so forth. So the delta is giving us an indication of the speed of the change of the premium relative to the change in the underlying futures price. And it's dynamic. It's the wonderful thing about these options is that none of this is static. So the influence on the delta changes, and it has a sensitivity as you approach the point of being at, in, or out of the money. Its highest sensitivity to change is at the money, and it increases in sensitivity as you get closer to expiration. And this reflects, if you think about this intuitively, it reflects that idea of probability. The longer term to expiration, the more chance the market has to push the option strike to be in, at, or out of the money. The closer you get to expiration, the more sensitive to the change in the price because there's less time for that to flip back and go the other way. So the greatest impact to the change in the delta is when it's at the money, and it increases in sensitivity as you approach expiration. It's also used in the calculation of hedge ratios. If I want to use options as a hedging vehicle against an underlying position, and I want to remain relatively effective in terms of the calculation in terms of net change to the underlying to the change or offset in the change in my options premium, I want to use relatively close ratios to my delta. So let's assume that a trader is long 10 of the June E-mini S&P futures, and they want to hedge a 50% risk position, or 50% of the change should the market go up or go down. And they're anticipating or very, very concerned about a 2.5% drop in the futures price of the E-mini S&Ps. The E-minis in this case are at 41.80 and a quarter, and they have 59 days until expiration. 2.5 percentage lower would be roughly 40.80 as an index price. So our trader wants to be hedged, particularly at that level. In other words, his pain threshold really kicks in at 2.5 points lower, 2.5 percentage points lower to 40.80. So we want to buy the 40.80 June put, which also has 59 days until expiration. That 40.80 put is priced at 64.5 index points. And each of those index points is worth $50. It has a delta of negative 34. It's got positive gamma if we're buying it. It'll have positive vega as buying the option, and negative theta or negative time decay for the long position. So to calculate the ratio, we've got a 10 contract risk position and we want to hedge 50% of it. That represents the equivalent of 5 futures contracts. So that's our risk factor. We want to divide that by the delta, 0.34 mathematically, which gives us a number of 15 options. So we want to buy 15 of those June 40.80 puts, and we're going to pay 64.5 index points for them. Each one of those is going to have a $50 multiplier. So 64.5 times 15 times 50 results in a capital outlay of just short of $50,000. That's the maximum risk that the hedge is going to have on this position, because as the option buyer, my risk is limited to the premium that I pay. So I've bought some downside price protection, 2.5 percentage index points below the market for a capital outlay of $50,000, and that's all I have to post. What happens if the market drops in price? Well, we were at 41.80 and a quarter. If the market goes down to 41.30, roughly a 50 index point drop, the underlying P&L is going to be negatively affected by $25,000. But being long those 15 out of the money puts resulted in an improvement in the premium to the effect of roughly $20,000, which means the actual loss to the core position was only $5,000, or roughly 20%. If the market continues to drop and reaches the point at which the 40.80 puts are now at the money, the core position will have lost $50,000, but is almost entirely offset by the increase in the premium value of the now at the money puts, demonstrating the effectiveness of that hedge ratio to the loss in the position. Now, why did the option increase in value at an accelerating rate? That's the dynamic nature of the option, because as the futures price is dropping, that out of the money puts delta is increasing, and it's increasing at an increasing rate, which means that the hedge ratio, which has remained static, is actually increasing also. So the short position that's created by the out of the money put is actually increasing its short value as the market trades down, owing to the dynamics of the long option position. The next group we want to consider is referred to as the gamma, and the gamma is defined as the effective change of the delta to a change in the underlying price. So you might think about the gamma as the delta of the delta. If you're familiar with the way bond mechanics work, bond prices, we refer to in bonds being long bonds gives the buyer what's known as positive convexity, which means as prices go up, their price goes up at an accelerating rate, and as price goes down, their price goes down at a decelerating rate. Their relationship yield to price is known as convex. This is what gamma is describing. A similar phenomena in a long options position results in positive convexity to changes in price. So as the price goes down in the underlying futures price, a long put position is going to go higher in value, and it's going higher in value at an accelerating rate. But if the price of the futures market goes up, the price of the put will go down, but will go down at a decelerating rate. And it's the opposite for calls. If the market is going up, a long call position will increase in value at an accelerating rate. And as the market goes down, that long call position will be reduced in value, but will be reduced at a decelerating rate. Its gamma is highest at the money, and it diminishes in value in terms of its impact the further you go in and out of the money. So let's consider our same position. A futures contract on the June E-mini S&P futures at 41.80 and a quarter, and the June options with the same expiration date. Our 41.80 strike, that at the money strike, let's look at that call now. It's got the same premium, 98, but we're going to look at the gamma. And it's a positive number if you're long. It will affect you negatively if you're net short. So all of the gammas, you'll notice, regardless of strike, are positive because we're looking at them as in this case, buying them. And it would be the same if you bought the put. It would be positive if you were long the put in terms of the gamma's function to the delta. So let's look at that call again. The 41.80 call with a premium of 98 and a delta of 51 has a gamma in this instance on our calculator of 0.0016. What does that mean? Well, it means if the futures price were to move up by 6 1/4 index points to 41.86, the underlying delta should change by 1. And we can back into this mathematically if you consider 6 1/4 index points times the 0.0016 equals an 0.1 of delta. So if the futures market were to go up or down by 6 1/4 index points, we would expect the delta on this at the money call to go up or down by 1 point of delta. Now, the closer you get to expiration, the greater the sensitivity. So let's consider a similarly struck option, in this case with a delta of 51, but with only 43 days until expiration. It's still pricing. This is a May expiration, an end of month expiration for the May option, which when I built this on the 18th of April had 43 days until expiration versus the underlying futures contract that it prices against still has 59 days. It's pricing to the June contract. The June contract at 41.71 even, at the money 41.70 call had a premium of 80.5 index points, had a call delta of 51. Notice the increase in the gamma, 0.001, basically 0.002. That means that it takes less of a change in the price of the underlying, only 5 index points instead of 6 1/4 to change the delta by a 1 delta point. So the closer we get to expiration, the at the money gammas are going to be most highly sensitive, which means, again, that's why the deltas change so sensitively to changes in price of the underlying if you're at the money closer to expiration. It's, again, dynamic. Most sensitive at the money, it fades in sensitivity as you move out to being deeply in the money or deeply out of the money, and its greatest sensitivity is closest to expiration. This becomes important if you're familiar with, if you've ever listened to or read any articles about options traders that might be what they call gamma traders. They're interested in short-dated options because they've got the highest degree of gamma. They're going to be most impacted by changes in the underlying price, which is what the gamma traders want. This is also why the popularity of short-dated options is so great. We're seeing the greatest amount of increase in trading at CME options in our shorter dated expirations, because even risk managers that are hedging to specific dates, for example, today is the beginning of an FOMC meeting in the United States. Our central bank is meeting, and tomorrow we'll be making a statement and we'll be announcing a potential change in its policy rate, the Fed funds rate. So tomorrow afternoon could be a very, very important day for interest rates and, by extension, other markets. If traders wanted to strictly hedge tomorrow afternoon's trading activity, they would want a very short-dated option that would have, by definition, an enormous amount of gamma because of its sensitivity to change relative to a short term to expiration. Just something to keep in mind. Vega is the Greek that we refer to that talks about the premium sensitivity to change in the volatility. So what we're going to be looking at in our description is a change to a 1% volatility, and that's 1% change regardless of direction. So generally speaking, higher levels of volatility increase the value of an options premium because of vega, and lower volatilities tend to depress the premiums because of falling volatility would be negative to the premium. Let's consider our same table here, only now looking at the vegas. The at-the-money 4180 calls with a premium of 98 have a vega of 6.634, and the vega is the same for the puts or the calls. And you'll notice as you move away from the at-the-money, both in and out, depending on put or call, or up and down by strike, the vega gets a little bit smaller. So again, the further you get away from the at-the-money, the vegas are going to shrink. The sensitivity to the change in volatility in this time is a little bit different. It's more sensitive the greater the effect of time. So let's consider, again, the same strike price, same underlying futures market. We're looking at an at-the-money volatility of 14.73, and the at-the-money call has a vega of 6.634. That means that if the volatility were to go up by 1 point of volatility to 15.73, the premium, everything else being equal, should increase by 6.63 index points. In other words, it should go from 98 to roughly 104.75. If the volatility were to fall to 13.73, you would expect a corresponding drop in the premium below the current price of 98. If you wanted to get more finely tuned, in other words, if volatility wasn't whipping around by 1 full percentage point, you can always just move the decimal over and use, instead of full points, tenths of a point to get to a rough number in terms of what the change in a tenth of a percentage change in volatility might do to the premium. And this, again, as I mentioned, is the opposite of what we've been talking about with delta and gamma. You still have the greatest sensitivity at the money, but you're losing sensitivity as you get approaching expiration. So the vega, or the sensitivity to volatility, is greatest on longer dated options rather than shorter dated options, because the volatility, the closer you get to expiration, has less time to affect the premium. The last thing we want to consider, at least in today's exercises, is the effect of time decay on the premium. And this is reflected in the Greek term known as theta. All options have an expiration date, therefore they have a death date. The theta is going to represent the effect of time decay over the lifespan of what's left in that option. And this expiration is not linear. it accelerates the closer you get to expiration. So the theta, while it's a positive number if you're long, is going to increase at an accelerating rate as you approach expiration, whether it's a put or a call. So this is, again, it reflects the dynamic nature of options. So let's consider the theta with two different time expirations here. We're going to be looking at the June E-mini S&P futures contracts with two different expiration dates. The futures in this table, 59 days until expiration with the same underlying futures price, 41.80 and a quarter. Same strike prices, as you can see on the far left column, but one with the month-end expiration, end of May, with 43 days. The other with the June expiration, 59 days until expiration. You'll notice that the theta on the at-the-money call is negative 0.902, which is a greater number than the same at-the-money strike of 0.821 for the longer dated option. If we were to look at a weekly option that expired in 7 days, the theta would be significantly higher than both of these because it's closer to expiration. So the theta represents the effective time decay on the premium of the option, and it's dynamic. It will accelerate the closer you get to expiration, and it would be the same whether it's a put or a call. So if we look at our 41.80 call again, it has a theta of negative 0.821. That suggests that every day, everything else being equal, the premium is going to deteriorate by 0.821 index points. So if everything remains the same, the next day, this premium of 98 should be roughly 97 and a quarter index points, or it's 3/4 of index point lower. Depending on market conditions, obviously, it's going to be somewhere between 97 even and 97 and a quarter, but because these trade in quarter index points, I just simply rounded it to the nearest number. And again, it's dynamic. It's going to be most dynamic at the money, closest and accelerating to the point of expiration. So let's take a real market example to kind of pull all this together. We've talked about the effect of the underlying price on the premium of the option reflected as the delta. We've talked about a change in the price of the underlying as it affects the change in the delta. We call that the gamma. We've talked about the price change in premium as affected by volatility measured by the vega, and we've talked about the premium change affected by time decay measured by the theta. Let's go back to April 26th. And if the E-mini S&P futures were at 40.92 and 3/4 points, I'm sorry, if we go to the 18th of April, the futures were at 41.80 and a quarter. Had 59 days to expiration. The June 40.80 call was at 98. It had a volatility of 14.73% and the delta of 51. The gamma was 0.0016, the theta negative 821, and the vega was positive 6.634. 8 days later, the futures contracts dropped by 87.5 points to 40.92 and 3/4. That same June 41.80 call is now priced at 53 index points, or 45 index points lower. The volatility didn't change by very much, but it was up slightly. You'll notice that because the prices are lower, the delta has fallen now to 36, and the gamma has increased because we are 8 days closer to expiration. The theta has also basically remained unchanged, but is still negative. And the vega has also fallen because we've gotten further away from at the money. So let's take a look at how this all kind of comes together. The market was lower by 87.5 points, so the delta is lower. There's been a decrease in the premium. Volatility is basically unchanged, and 8 days have passed. So if we look at our inputs at the time this trade was, or this position was marked, versus the marking 8 days later, volatility would have subtracted maybe a half of an index point in premium from the time decay, reducing it from by value by 6.5 points. The decrease in the underlying futures are going to take away roughly 38 points of the original premium. So if we started with an average delta, or we started with a delta of 51 and it's now 36, the average delta 43.5 with a drop in price of 87.5 index points implies the 38 index point drop. So all of those things added up and subtracted from the premium get you roughly to where it's currently priced at 53. All of this designed basically to show you that the mechanics of this make sense. All of these inputs obviously operate independently of each other, but you can see how with a good formula and a good model, you can get reasonably close, or you can at least begin to appreciate the impacts of the changes in the underlying inputs to the changes in the premium. There's another point that we want to bring attention to, which is known as put-call parity, or parity in options premium prices. When markets move around, obviously the puts and calls at various strikes are going to be changing dynamically with changes in the underlying price. And because of all of these inputs we've talked about today, their premiums are going to be adjusting to account for all of that. But what imposes the pricing integrity on the relationship between the price of the puts and the calls at a similar strike relative to the price of the underlying? And this is called parity, or put-call parity. And if you want to think about it, the integrity is imposed because there's a lot of very sharp options traders out there that understand that with a combination of a long put and a short call, or vice versa, you can create a synthetic futures position. And if the combination of the same strike, put, and call is somehow out of line with that actual price of the underlying futures contract, there's a potential low-risk arbitrage trade. These combination trades are what imposes the pricing integrity on the put-call relationship. So let's look at an example. If the E-mini S&P futures for June are priced at 41.63 3/4, the 41.70 calls priced at a premium of 102 3/4, and the 41.70 puts are at 109. If I sell the call and buy the put, I've created a synthetic short futures position, and that would result in a 6.25 point debit to me. If I consider that versus the strike price relative to the underlying futures price, you'll notice it's the same spread, 6.25 points. That implies that there is parity between the puts and the calls and the underlying futures price. There would be no mispricing here, no arbitrage opportunity. That's the thing that keeps the puts and the calls in line with the futures contract. Now, there are still these other dynamic things that go into this, which we're going to explore in our next session together, called volatility skews. So before we get to that, let's take a pause today. And Mark, I'm going to suggest that we take any questions that your audience has over the material we've covered today. Or if you've got any throwback questions to our previous session, I'll be happy to answer those as well.
Well, we've got some questions regarding the time decay effect on a probability of an options trading strategy. I mean, do you want to save that for the trading strategy next week, or
no? Go ahead and let's hear about it.
Well, let's questions on how an options time decay affects the probability of an options trading strategy, like a long straddle or a short strangle.
Well, we're going to cover both those strategies in our meeting next week in person. So I would highly encourage you to come back. But the short answer to the question is, it depends on whether you're long or short. So a long position that pays premium is exposed to time decay, whether it's an outright position or a spread position. If you're net long, the probability is you're going to be a long time decay because you've paid premium. If you're short and you collect the premium, you're going to generally benefit from time decay. In other words, if you're short a volatility spread and the market doesn't go anywhere and time rapidly disintegrates, in other words, a short dated option, the theta is going to be very negative and it's going to be very high, and the collapsing time will benefit the seller because there's a greater opportunity or a greater chance that he will be able to retain the premium he received at the point of execution. So the short answer is the time decay affects the position dependent on whether they are net long or short the premium.
Sure. Whether or not you want the clock to run out, or how quickly you want the clock to run out.
Is it working for you or against you?
Yeah. One of the things that, I mean, forgive me if this falls under the skew aspect that you were mentioning just now, but when I was, call parity, but, we know and we can witness that equity indices, they fall faster than they rise. There's more volatility in falling markets. And when I was being taught options, we were told about put premium. Is that covered in the in your aspect of skew, would you say, or is that just how is that factored into the options pricing?
That's exactly what we're going to be talking about when we talk about volatility skew. And
Right.
you point out correctly, Mark, that in the equity market, because you're talking about a physical, the underlying being or representing or replicating a physical asset, as prices go down, the volatility tends to go up because people are generally concerned about losing the value of the underlying. So if we were to look at the distribution of the volatilities along the strike prices of say the S&P index, you'd note that the volatilities are increasing as the strike prices go down to reflect that the value of price protection to a downside move. It's less dramatic in the calls. Sometimes skew is referred to as a volatility smile because in a lot of markets, it's uniformly, it increases as you go out from the at the monies. But in the equity world, it's not so much a smile as it is a smirk. It tilts to the left-hand side or to the put side or the downside portion of the market. Now, in commodity trading, you may experience just the opposite. There could be greater risk to price increases, where you could see more of a smirk tilted to the other side of that, or the right side of that distribution. And in some cases, it's truly more of a smile. We're going to talk about skew and what that means dynamically in our session next week. So please come back and join us then.
Absolutely. Few questions regarding vega. I think it's kind of caught people's attention. Is high vega good for options? Can it ever fall to zero?
The second part of that question, I don't know. I can't imagine anything having a volatility of zero, although volatility can fall precipitously. And a good example of that was just a few years ago. Recall that in the spring of 2020, when COVID became a global pandemic, the world went on lockdown almost universally, and economies fell into basically a depressed state. The response by central bankers and policymakers around the world was, at least in the United States, it was to stimulate by dropping interest rates to zero and putting money from the US Treasury back into the hands of taxpayers and consumers to continue to spend. But moving interest rates down to zero had a distinctly depressing effect on short-term interest rates, particularly the Fed funds contracts and other short-dated interest rates at CME Group's interest rate complex, because the central bank had basically gone to zero and had stated in its statements and policies that they would not be raising interest rates in any time in the near future. Well, that just implies a zero interest rate ad infinitum for trading purposes, which means that the volatility in Fed funds futures dropped dramatically. Volatility on two-year notes in treasuries dropped dramatically. They didn't get to zero, but they got awfully close because there was absolutely no change in the policy and no hope of change until late 2021. So market conditions can depress volatility, which would have a negative effect on premiums. But you've also got the positive effect of rising volatility that would have a positive effect on option premium. So vega represents the measurement of the change in the premium to the change in the underlying volatility. What moves the volatility around, I'll leave to the academics to describe that phenomenon mathematically. But for traders, volatility is sometimes a very good thing if you're long premium. For risk managers, volatility can be a very dangerous thing, and they want to protect from volatility. And again, this is one of the distinctive benefits of listed options over and above even futures contracts, in that because volatility is an input, volatility can also be isolated and traded as a risk strategy. We can construct trades that benefit from rising volatility that are relatively directionally neutral. We can construct trades that benefit from falling volatility that have a relatively lower sensitivity to changes in direction. So these are going to be some of the things we talk about next week in our third session.
Excellent. We look forward to it. Just for everyone's benefit, this will be a live. We actually get to meet David in person. We're all very looking forward to it. It's going to be at the Habtoor Palace, Dubai, on the 11th of May, between 3 o'clock and 5 o'clock. So please come along. It will be streamed as well. I did also want to add as well, because I forgot to mention at the beginning, that the slides from the first presentation are available. Just drop us a message or an email. We're happy to send those to you, and also from this presentation as well. So yeah, please let us know if you would like those. That'd be good revision, I think for all of us. We have a question here, if you wouldn't mind, just a little bit more expression on the theta. Someone has asked about the difference in time to expire of a future 59 days and the expiry of an option 49 days, and how that would affect the theta.
Well, the theta describes the impact of time decay on the premium of the option, and it's regardless of the underlying futures contract. It's the expiration of the option that becomes important at that point. Now, we have a lot of options listed at CME Group, and dependent on the product, the expiration of the option doesn't have to coincide with the expiration of the futures contract. In most cases, they're not the same dates at all. Because we've listed so many short-dated options, you're going to be looking at, and I don't have it in this slide deck, but you may recall in the previous session, I showed you an example of what I called the open interest heat map, which showed the underlying futures contracts and all of the various options, usually listed in term to expiration, that trade against those contracts. We now have, and I'll just use, since we're talking about E-mini S&P futures, I'll use those as a working example. We have expirations almost every day of the week now. So you can have an option expiring, today is Tuesday. There's an options expiry today. There'll be one tomorrow. There'll be one on Thursday and Friday. They have obviously only days left until expirations. Their thetas are going to be huge. The time decay impact of moving away from at the money will be very, very dynamic. If we were to look at an option on the September E-mini S&P futures that has over 90 days to expiration, you're going to notice the theta on that is very, very small because it's a long way out in the future. The impact to the change of the premium is going to be less dynamic or less dramatic than a short-dated option. So being mindful of the expiration of futures contract is important. But if you're looking at the option and its impact to change at expiration, it's far more important. In fact, it's essential to know the expiration date of the option that you're looking at. And always be mindful that that could be an entirely different day count than the underlying futures contract from which it's deriving its pricing information. So The other thing to be mindful there is that in a physically settled futures contract, we'll use gold as an example. Gold is a physically settled futures contract. And in order for the options on gold to have open interest to exercise into, those expiration dates on the same dated options. For example, if we're talking about a June gold contract and a June expiration on a gold contract, the expiration of the option will be in May because it has to precede the first delivery date of the futures contract, because theoretically, all the open interest in the June futures could disappear on first delivery day, leaving the long options position, if they were allowed to trade all the way to the first business day, with nothing to exercise their rights to. The short would have nothing to be able to deliver, because remember, the obligation in options at CME is to a futures position. So in order for the short who gets assigned that position to create the position in the futures contract, there has to be open interest. So physically settled futures contracts, the options have to expire prior to any delivery mechanics of that underlying futures contract in order to be efficient and effective. So you need to be cognizant of the expiration dates, and all of that's covered in our contract specifications tables that you can see on cmegroup.com for all of our products. I mean, sorry, Mark, long-winded answer there.
No, that's good. I mean, I can echo your kind of views on the numbers of or the popularity of the kind of daily options expiries on the CME, on the S&P. We have a growing number of clients who are interested in watch that and trade that. So yeah, I can completely understand the appeal there. I've got a good question here, I think. How does the concept of time decay differ between American style and European style options?
Ooh, that is an excellent question, because European style options only allow the right to exercise at expiration. Their prices trade differently than an American style, where the long option can exercise their rights at any time. How that affects time decay, I don't have a direct answer to. I think what you've got there is it's reflected more in the valuation of the premium, regardless of the optionality to immediate expiration. I think that's one of the reasons, if you wanted to think about this a little more deeply, why would an at-the-money theta be most sensitive? For exactly that reason. As if the market's moving higher and my call is going from out of the money to at the money, there's a higher probability in an American option that the owner might exercise his option or her option. The more deeply it becomes in the money, the greater the likelihood that the American option holder would exercise their rights. So it just validates the sensitivity to being at the money and closer to expiration. But as the questionnaire points out, the American style option is going to be priced entirely differently than an equivalent European style option. I don't have a more specific, detailed answer mathematically as to the difference in how that might price out.
Excellent. All right, thank you. And I think the last one we have is, how does a trader use delta to hedge their positions? I know you had an example of the 50% futures trader, but maybe on a kind of broader level, how do traders, use delta on a day-to-day basis?
Well, it's an interesting concept, because it can be used in a lot of different ways. You can hedge either an underlying position, you can hedge a underlying futures position using options, and that's generally done through the expression of the delta. But there are also plenty of options traders that, by the formulation of the delta, use the futures contracts to remain relatively neutral. These are known as delta neutral style trades. Because the dynamic nature of the delta, it means that the active trader is going to be actively adjusting their core position, whether it's adding or subtracting options to remain somewhat delta neutral, or adding and subtracting the underlying futures position to remain delta neutral to the options position. But conceptually, I think the theory is that I'm using my delta to arrive at the equivalent number of futures contracts. So if you think of an underlying futures contract as always having a delta of 1, if I have an option that's got a delta of 25, I need 4 of those to equal a delta of 1. So because we think of the deltas mathematically as a 0.25, one option with a delta of 25 is only a quarter of the underlying futures contracts price impact. So to be delta neutral with a delta of 25, I would need 4 options, put or call, to equal 1 futures contract. Or if I had a delta of 50 and I wanted to be delta neutral relative to the futures contract, I would need 2. If we looked at it the other way around, if I've got my net delta position is 0.25 and I wanted to hedge my futures position and I had 4 of those 25 delta puts or calls on, and I wanted to hedge my risk position directionally, I would buy or sell 1 futures contract to remain relatively delta neutral. Now you can see, just as I've said that, as the market's moving, the delta's changing, and my delta hedge ratio or my delta neutral number is going to be changing as well. So if I'm short puts and the market's falling and I want to remain relatively delta neutral, I'm going to be increasingly selling futures contracts to offset my risk of the increasing delta of my short options position. This is another reason why that open interest heat map I find so valuable, is because it shows me where there are big pockets of puts and call open interest. And knowing that there are a lot of delta neutral traders out there, if the market is approaching a pocket of large open interest, the short options positions are going to be dynamically using the futures contracts to try to stay as close to delta neutral as possible, which may in effect have a self-fulfilling effect on the futures pricing.
Understood. Understood. David, we thank you so much. We're approaching the end of the webinar, and I didn't want to cut you off or have the meeting kind of cut off kind of like while you were mid-sentence. This has been absolutely fantastic information. We thank you so much for your time. Thank you to everyone else who's joined in today. I hope it's been valuable. Like I said, thanks very much, and please do come along on May the 11th to the live webinar that we'll be hosting in Dubai. For the slides, please drop us an email or a message here and we'll get those to you. Thank you again, David, and thank you very much everyone for joining.
Looking forward to seeing you next week. Thank you, Mark.
Okay, thank you, David. Bye-bye.